All right, welcome to the Monday edition of the On the Tape podcast. I'm Dan Nathan. I'm joined by Guy Adami.
Yo.
So on Mondays, Guy, it is EY from SoFi. That would be Liz Young. She's the head market strategist at the aforementioned SoFi. Liz, welcome.
Hello. Happy Monday.
Happy Monday.
Can I tell you something? It's a stormy Monday. It's rainy. I mean, your Packers, tough loss to the Falcons. By the way, the 2-0 Falcons, Dan.
Yeah, well, I got to give a shout out to my main man, Dave Ragone. He is the offensive coordinator for those Falcons there. 2-0 guy. And let me tell you something. I was in New Jersey last night. I was on the beach at Asbury Park. They had a couple TVs set up. I was there for a Foo Fighters concert.
Love the Foo Fighters.
See here now, and they had dual screens, as they say in the biz. They had one tent with the Jets game on and one tent on with the Giants. And I go and I look in the second quarter. The Giants are down 20-0. Okay, 20-0 to the lowly Cardinals of Arizona, and you guys pulled it out. I mean, honestly, it would have been a
well. I wasn't playing for them, so I appreciate you saying you guys. I'm not one of those people that speak about my teams as we. I love when the callers say, we lost. Like, no, you didn't. You didn't lose because you weren't effing playing. But that's neither here nor there. The Giants emerged victorious. The Giants that I root for, but it's not we.
All right, fine. Well, 0-2 Giants would have been a devastation here, and you're 1-1 pack, Liz. That's fine. That's fine. Guys, let's get on to it.
We only lost by 1 point. Jordan Love finished the game, I think like 14 for 17 or something, 14 for 19. Not a bad showing.
All right,
I'll let him have it. He's 24 years old. 24 years old.
To say about your point about only losing by one. Guy, get in there and say something.
Well, I mean, whether you lose by 41 or 1, Elizabeth, in the National Football League, it counts as a loss. You don't get style points. This is not figure skating. No style points.
Matter of fact. All right, we got a big show because this is Fed week. Liz is going to be doing a Fed-A-Palooza. She is going to be on CNBC on Wednesday. She's going to be on the halftime report with Scott Wapner. She's going to be on the closing bell with Scott Wapner. In between that is going to be Fed Chair Powell. They're also going to have Jeffrey Gundlach. And I always find what he has to say actually very fascinating. But there's a whole heck of a lot of stuff to go over here, just getting everybody set for this week. But first, stick around for our conversation. I had a great conversation with Mark Simmer. He is the managing partner and CIO at Clear Haven Capital Management. We talk a whole heck of a lot about what's going on in the credit markets, private credit in particular, and he had a lot of great insights there. But guys, okay, let's talk about it. So on Wednesday, we have the Fed. There's a whole host of things that we want to hear from the Fed about dot plot, how the Fed are thinking about the potential for a soft landing. We talked about this a little bit, I think, last week. Fed Chair Powell guy, I think it was a week ago Friday, was doing all of these off the records with the financial media, with a bunch of investors, that sort of thing. They're trying to paint the picture for a soft landing here. But here's the thing I just have a hard time thinking about is that we have crude oil above 90. It's 92-ish. One of them is trading at 95. You can tell me the difference between 92 and 95 with WTI and Brent here. But it's kind of hard to imagine that we are going to have a soft landing with crude oil where it is. And then you think about inflation expectations coming down. It seems to be there's something's got to give here, Guy. Talk to me a little bit about the potential for the Fed to nail this narrative, especially when we hear Fed Chair Powell on Wednesday afternoon.
Yeah, I've thought that's a pipe dream for a while. But, with each passing day, I think the likelihood in some people's mind becomes more and more likely that they'll be able to do this. But if you just look around and say to yourself, how in the world is this going to be possible? When you look again to this morning, as we're sitting here, 10-year yields back above 4.35%, levels that we last saw in October. Yields are extraordinarily sticky. And again, I would submit they're going higher for the wrong reasons. You're seeing it across the globe as well. You're seeing a breakdown in Japan. Peter Bookvar wrote about that earlier today. We've done podcasts about that. I don't want to get too granular, too wonky here, but that has impact in the United States markets without question. And to a certain extent, I think you're seeing it in the bond market. And, they say in the airline industry, any landing is a good landing. I get it. But with that said, this landing is going to be bumpy as hell. And, the plane's still in the air without question. but they're looking for a runway, and I just don't think they're going to find one that's going to suit their needs.
All right, Liz, I just mentioned, "It's Hard to Imagine." I was at a Pearl Jam show the other night, and they played the song, "It's Hard to Imagine," and you just gotta think about the lyrics here. Things were different then. It's all is different now. I tried to explain somehow. Things were different then. All is different now. Just think about this, where crude was last time it was trading at these levels above 90, it was last fall, last October. The S&P was what? Below 3,600 for a spell. It's 4,450 right now. We think about all of those inflationary inputs that companies were able to pass through, right? And with the sort of pricing power that they had for a whole host of reasons here. I think it's a little different now. I mean, that's what I'm kind of getting at here. And you've talked a lot about this. You've said we're at that point. We're at that 18-month mark, right? Since the rate increases started. And it really feels like we're going to have a bunch of this data start to smash into each other in a way that maybe stock market valuations are not discounting.
We're at the 18-month mark since the hiking cycle began. We are at the 15-month mark since the yield curve inverted decidedly and stayed inverted. And you can't argue that point, right? It's been inverted for that much time. This is exactly the point when things usually show up. And I think some things have showed up, but the data so far has not conclusively shown that there's a ton of stress in the system. However, yeah, you have to, number one, look at the bond market. Number two, think about it logically in the sense of oil prices are high again, gas prices are high. So there's some justification for certain types of companies to pass that through. Airline fare probably stays high. That's justified. Maybe used car prices. Well, there's certain things that are obvious knock-on effects of high oil. However, things like consumer staples, consumer discretionary, goods prices that we know have come down, input costs that we know have come down, no longer can be justified to pass through to the customer. Not only that, now the customer knows that inflation is down. You keep raising prices and they're going to just resist, which is something that I think we talked about last week, where we have this big trade down that's happened with the consumer. And you've got a bunch of businesses that are seeing a consumer that they don't usually see coming through their doors or shopping on their website because of that simple fact. Consumers are no longer willing to put up with the price increases and the pass throughs. And they're saying, you know what, then I'll just shop somewhere else and I'll buy different stuff until this goes away.
Yeah. So, Guy, it kind of feels like a little bit of a perfect storm for U.S. multinationals here. You think about, Liz just mentioned the dollar, the U.S. dollar index, the Dixie is approaching 106. That's a level that really it hasn't been at. It's been a couple times over the last kind of year, but it was really a breakdown level last year when the S&P was, very near its lows. So you have the 10-year U.S. Treasury yield also at levels that it hasn't been since last fall, right? That 4.25 level. Carter's been kind of charting that out for us on Market Call over the last few weeks. He thinks lower, you think higher, but higher rates, higher dollar, higher crude oil. I mean, it's kind of, what do you call that? A witch's what? It's something.
Witch's brew. And we're into that season, by the way. I saw a lot of Halloween decorations. I don't know what people, but listen, never, I guess it's never too early, right, to get into the
I bought a
holiday spirit.
Christmas tree last night, just
Oh,
Please tell me
FYI.
you no, you did not.
I did.
That's
Wait, Guy,
that's
Liz
It
is
was
that
on sale.
person who you might find meandering at a Christmas store, a Christmas tree store in like the dead of summer. You know what I mean?
yeah.
You are that person. You buy candles at all times of the year, right? And you're buying Christmas trees and you're just stocking up.
Christmas is in December, by the way. I mean, let's just set the expectations for people. Anyway, in terms of what's going on in that witch's brew, I completely agree with you, Dan. A higher dollar, I don't think it's a particularly good thing. We had Mike Cow, not Mike Coe, on our podcast last week, and he spoke exactly about that, the wrecking ball nature of the dollar going higher, that I don't think the market is fully pricing in. And again, it goes back to what I said about Japan. It also has a lot to do with what's going on in China and the weakness in their currencies. And then you layer on that the recession we're seeing across Europe. I mean, it doesn't paint a particularly good picture. Dollar higher, not a good thing for the stock market. Rates higher, as I mentioned. Listen, if rates were going higher because magically our economy was robust and doing well, I'd say, you know what? Maybe you could justify the valuations that people are paying for stocks, but they're not going higher for those reasons. They're going higher because the market's demanding a higher yield to buy our debt, number two. And the last thing you mentioned is crude oil. Crude oil is on its horse. People are not talking about it. It's a supply-demand imbalances that we've talked about for the last couple of years, finally manifesting itself in the price. You throw in some geopolitical stuff out there, and you have higher energy prices. Even if crude went nowhere for the remainder of this year and early next year, it doesn't matter. That's in place. And Elizabeth can speak to this. We saw the inflation data last month. Well, guess what? It's going to be worse the next time we see it. So we have said for a while that inflation probably troughed a couple months ago and would reaccelerate into the fall. Well, we're starting to see that now, Dan.
One of the things, hold on, there's a quick stat that I want to mention, and I don't know what it reads as right now. I'm guessing that it's still in the okay zone. But when you think about how oil prices affect the consumer, how it affects spending, there's a threshold that if you look over history, once gas prices or once energy in general becomes about 4 to 4.5% of what a consumer has to spend on it, overall spending, right? You look at disposable income. Once it hits that 4 to 4.5% mark, usually there's stress that shows up in the market, in the economy afterwards, because that's not a sustainable level of spending for the consumer. So that's something to watch. When oil prices did spike a couple years ago, we got pretty close to that, if not right in between that 4 and 4.5% mark. But then they came down quickly afterwards. We still had a lot of stimulus in the system. It was justified to pass through those prices, right? I don't think that we're in that kind of situation anymore. And now that we're here 18 months into a tightening cycle where capital is restricted, that spending is a lot more fragile.
Yeah, it's also a few things I think, Guy talks about the, consumer confidence is really just an overlay of the S&P 500, right? And here we are, we're down a few percent from those recent highs, but lots of stocks, like lots of big stocks in the market and some of these big tech names, are down more than 10% if you think about an Apple or you think about a Microsoft. I just saw a guy, in Netflix, which is one of these companies that had this huge, 200+% rally off of its, last 2022 lows. That's down, 20%. AMD, it's been wrapped up in this AI bubble. It's down, more than 20%. So some of the technicals of some of the sentiment leaders they're kind of coming undone a little bit at a time where all of those things that you just mashed together on the economic front. And then I think, Guy used this expression that people are not talking about this or people are not focused on this. I mean, think of the potential perfect storm that we have in the next few weeks. Let's say this UAW strike goes longer than people expect. Let's say that our government is headed for a shutdown. Let's say that student loan repayments next month are something that maybe people couldn't put their finger on what that meant for the sort of pent up spending post COVID, right, at a time where we have hundreds of billions of dollars of student loans not being repaid by a certain part of, let's just say, the workforce that felt emboldened about a whole host of different things, you know what I mean, as it related to wages and job security. And that seems to be changing a little bit, right? At a time where, say, I don't know, like all those things together really feel like the stock market. I'm going to go back to the stock market with a VIX. You guys know where it is. It's, below 15, doesn't seem to be appreciating it as it relates to year over year, because year over year at this time, investors were panicked and now they see absolutely no fear.
Let's sort of click these off one by one. So you mentioned the government potential for a government shutdown. As we're sitting here, it's September 18th, couple weeks left. I don't think the news media will start to talk about it. You saw a little bit over the weekend. It will start to sort of ramp up steam. You'll have the bipartisan two people come on to different shows and talk about their plan and how we. But the reality is, I think the speaker's up against it here, and there's a small faction that I think controls his destiny, and I think this is going to get pushed out to 11th hour. We'll see how that shakes out. But you're right. The market is not taking that into consideration. In terms of some of the other things you said, this auto worker strike, stick around, people, because I don't think this is going to get rectified anytime soon. It's just my opinion. But they seem to be pretty well dug in, the UAW, around 40% pay increases. I think they maybe got down to 36%. I think Ford countered with 20. There is still a huge chasm between the two. And listen, I'm not taking the side of either party, but you think about the last 10, 15 years for automakers. I mean, these are the golden years for those companies, not for the stocks, but for the companies. And the workers they have not basically kept up with the cost of living, and they're trying to get it back in one fell swoop. So I understand that they're pissed off. So I think that lasts long. I don't think the market's taking that in consideration. And all the geopolitical stuff. I mean, again, apparently there was some clandestine U.S.-China meeting over the weekend. We sent somebody out to try to sort of simmer things down on that front. Obviously, this is UNGA, United Nations General Assembly Week, which is just a joy for people trying to traverse Manhattan. We'll see what comes out of that. But you throw all these things in a pot, stir it up, and none of them are particularly good, in my opinion.
Word of the day, clandestine. I
You
say
like that?
clandestine, but
Oh,
clandestine.
Okay, now listen, that's fine. That's a Midwest thing.
Yeah.
Clandestine, clandestine. It's all
Love it.
fine.
Love it.
I'm like sort of the British version of English, but back to
Oh,
you.
I see. You're so much more sophisticated than the rest of us. Would you like a spot of
Liz
tea?
Liz, let's talk about this. We just mentioned a bunch of risk assets that are moving around like crazy. We had the 10-year at 4.35, it was at 3.80 about, 2 months ago, that sort of thing. We have crude, the move that it's made, a whole host of things are moving around. The US dollar, the volatility in the equity market, again, we have an S&P that's down 3.5% from its highs in late July. When you think about all those things we just listed, and when you think about the Fed week, okay, so in the middle here, we have on Wednesday, the Fed's going to come out. Do you think there's a potential for equity market volatility? Again, and I just want to highlight the fact that, a week and a half ago, it seemed like the Fed, Jay Powell in particular, was kind of setting the tone for, market participants getting comfortable with this soft landing scenario. I do think it's interesting, and I'm not trying to get Guy all worked up on a Monday morning here, but in the journal, why a soft landing could prove elusive. This is from the Fed Whisperer. That's Nick Timmeros,
Mm.
So
I
hold
know,
on a
I
second.
know, I
Why?
know,
Oh,
You should
no.
just
I
the
know,
Fed whisper. I mean,
I
is
know.
that self-titled Fed? What is it?
No,
He's
but
about 5'4", right?
the
The reason
journal
he's a
always
whisperer
has
is
one of
because they
these.
don't see him coming. Like he hides under the desk and listens to him.
No, what it means is it's the
No,
guy
that's what it
there
means to
kind
me.
of
That's what it
whispering,
means to
kind of
me. He's a
floating
little
the
nebbish.
all right,
I'm the Fed whisperer.
floating the trial balloons, that
Who was the other Fed whisperer? The other guy, he was equal. You put those two guys together, and maybe they could play. If you literally put them together, maybe they could play in the NFL. Because independently, they're like, I don't know what they're doing. Maybe they're doing curling or something. Maybe they're the guys that sweep the
correct.
ice.
Maybe. All
Anyway,
right. I
sorry.
did that. I did that thing. But the question I had for you is the potential for volatility. And obviously, I mean, downward volatility in the stock market. Again, I'm not wishing it, but we've said this again and again. The stock market here doesn't make the Fed's job that much easier, right? If you will. So I guess my question is, if I look at the S&P 500, between now and Friday's close, it's pricing about a 1.25% move in either direction. Okay, so if you just wanted to buy an at the money call or an at the money put, let's say you wanted to kind of place a bearish bet and buy that at the money put, you are risking less than 1% between now and Friday's close. That seems like a pretty good bet based on everything that we've just outlined. Now, the flip side of it is, if you want to, make that bet to the upside that the Fed maybe comes out and they're really dovish and everything sounds great and they're going to nail the soft landing. And that in that scenario, the S&P 500 should move up. It should go back towards those 4,800 all-time highs from the first week in January 2022. So my point is, I don't mean that this week, but there are cheap ways to express those views in the market. But, the only thing not working across the whole, at least risk assets that I see, from a volatility standpoint, where you're getting paid to kind of define your risk and make a view, it'd be the stock market.
I think the setup here is threefold. First of all, I think all three of us can agree that generally speaking, valuations are a bit high given where we are in the economic cycle and given where we are in the tightening cycle. So the setup is that there is always an increased risk for volatility when the VIX is low and valuations are high. So that's just number one, building block. Number two, the Fed is never going to say that they see a recession coming. This is one of those months. This is one of the 4 times per year where we get their summary of economic projections and we get their dot plot. Jay Powell is not going to come out and say, okay, so we've worked into our projections the idea that there's going to be a recession at some point in the next 6 to 12 months. So that's not what we're going to hear from them. But the second building block in the potential for volatility is when the market seems pretty sure of what we are going to hear from them. Because what if then, even if it's just commentary that's different than what the market expects, there's potential for volatility. And the last thing that is always present for a Fed meeting, I say this every single time, I will say it again, the most dangerous time to trade is between 2 and 2:30 p.m. Eastern time. We get the data at 2, he starts talking at 2:30, and inevitably the market moves quite a bit, maybe in both directions and ends up where it began, but it ends up being very, very volatile, at least for that 30 to 45-minute period when his commentary is happening. And usually there is a question by said Fed whisperer from the audience, and that particular question tends to move it quite a bit too. So it's something that you can't hang your hat on. You can't give as a foregone conclusion. We do not know what he's going to say. And I think that this is exactly in the time where, and I would have thought that it would have happened already, where we start to get dissension among the voting members. And it hasn't quite happened yet, but I think it will begin, and that will increase the uncertainty and just increase the chance of volatility every single time we hear from them.
Yeah, I agree with that 100%. I was surprised you didn't get more of it at Jackson Hole. I thought that would be a perfect time to sort of hear, differing voices and, to Liz's words, some dissension in the ranks. You didn't get it. Not that they spoke with a common voice, but I think you're going to start to get more of it as we get closer to year end. And it makes, listen, given what's going on, it makes sense because depending on what side of the aisle you're looking at this data, I mean, you can make a compelling case for rate cuts in the beginning of next year, which I don't see, or continued rate hikes this year, which I don't see either. So, and that's what we're coming down with. And I think that's why it's so confusing for people, Dan. And, we get some interesting names this week. You got FedEx on Wednesday. I mean, say what you want about FedEx. It is an important barometer of what's going on. I think the stock is trading about 250 or so. It's nowhere near the all-time high, which I think we made back in, I think, the spring of 2021 or something like that. But it's had a little bit of a decent run. It's been lower left, upper right. Listen, I think FedEx is really interesting here technically. I mean, if you look back, you can make a very compelling case that we're potentially putting in the other shoulder of this head and shoulders formation that started in January of 2018. So we'll see, but don't discount the importance there. And by the way, you mentioned NVIDIA, Dan, very quietly. That stock's probably down 15, 16%, probably more if you take into consideration that 516 print that we saw in the aftermath of their earnings release, trading around 425 or so. And nobody's really, obviously, when it goes down, nobody talks about it. But it's, you mentioned AMD earlier, trading either side of 100. Well, throw NVIDIA in that as well, Dan.
Yeah, no, I think there's some technical damage that's happening in some of the market leaders. That's why I just kind of wanted to bring that up a little bit. And it's not too different than late 2021. We spent a lot of time then talking about the deterioration in many of the sentiment leaders at many parts of the market, right, that had done really well in the back half of 2020 and early 2021, and they were kind of rolling over. But the fact that the S&P and the Nasdaq were making new highs in Q4 of 2021 right into the first week of 2022, it was apparent to us that we were going to be in a bear market because many parts of the market, many parts of, whether there were recent IPOs or SPACs or crypto, and meme stocks, and the list goes on and on and on, they were cratering, you know what I mean? And then we saw Tesla and Meta and some of those things top out in late 2021, NVIDIA also. So to me, I think we could be in a very similar situation. And the technicals are saying that. Guys, one last thing before we get out of here. I just thought this was a really interesting couple of headlines I saw on Bloomberg over the weekend. One was ex-JP Morgan gold trader sentenced to 6 months in jail for spoofing. Okay, so this was a market maker at JP, and I guess a handful of these traders pled guilty to this. This guy's going to jail for 6 months. They were spoofing. They were putting basically fugazi bids and asks, up on the market screens. This was between 2008 and 2010. And think of all the things that went on at major investment banks in the lead up to that period and during that period. And none of those guys, and they're all guys, went to jail during the financial crisis, and you're sending some gold traders to jail for putting up fugazi bids and asks, which we know goes on in every market. I mean, guys,
It's
speak to that a
interesting.
little bit.
Well, I got to be careful here because I don't know who's listening, but I'll say this. You said fugazi bids and asks. So if you put a bid into the marketplace, somebody could hit that bid. If you put an offer into a marketplace, somebody could take that offer. So you say fugazi. If what I understand why you're saying it, but the reality is, if you put a bid out, somebody can hit it. If you could put an offer out, somebody could take it. So were they trying to manipulate prices? I'm sure they absolutely were trying to. But with that said, other market participants could have taken advantage of their air quote fugazi bids and or offers. But I think the point you're making is more important. The fact that there were far more criminal activity seemingly going on in 08, 09 that nobody was punished for. And you have a couple guys bidding and offering, gold market that nobody ever cares about. And those guys are doing some time in Rikers. Doesn't seem to
Yeah.
make a lot of
Well,
sense to me.
yeah, and the other headline, Liz, is ex-Wells Fargo executive avoids prison over account scandal. Now, remember the fake account scandal? And they were doing, I mean, listen, this is different. I mean, this is more SEC sort of stuff, like as it relates to, you know what I mean, the business of Wells Fargo. And again, they were in the penalty box for years. They still remain that way. But it's just interesting in a way how, like, some of these folks have probably been scapegoated from these banks, if you think about it, right? And especially because of all the criticism of all the activity in the 2000s and lead up to the financial crisis, and nobody went to jail. No, and I'm not saying that I don't know whether it's just really interesting that all these years later that we're now having folks like basically could go to jail. I don't know. It seems kind of odd to me.
You know,
Yeah, it
I'm
is
sorry.
it's a strange situation. It's an odd topic to suddenly be coming back up. And who knows? I mean, it could just be that we're trying to make an example. I don't know that it's the right example given everything else that had gone on. But look, I got to be careful here too. Obviously, the other thing is when you think about what happens in crises, we talked about this earlier in the show, it's always different. Yeah, it is always different. And if we have a crisis this time, it'll be different the catalyst that took us into it is different, right? I think crises happen for a handful of reasons. There are certain outside forces that cause them. The 2008-2009 crisis was a crisis of too much risk in markets, too much risk taking, and a blind eye towards it, and then probably a lack of transparency. If we have something this time, it's probably not caused by the same catalyst. It's caused by tightening, it's caused by credit crunches, it's caused by credit deterioration, but hopefully not criminal activity, right? And I think coming out of the 2008-2009 crisis, there was quite a bit more potential and real criminal activity.
I've seen enough movies, about prisons and stuff. So can you imagine like the cafeteria table with these guys? Because it's what I mean. Think about what they talk about. What are you in for? Yeah, I got into a fight at a Ravens game with a bunch of guys. And what are you in for? Yeah, extortion, blah blah. What are you in for? Well, I was spoofing the gold market. I mean, you get beat up for stuff like that.
Yeah, well, there you go. Things were different then. All is different now. We tried to explain, people. We appreciate you being here with us on a Monday. Liz Young, Guy Adami, I'm Dan Nathan. Thank you guys. Stick around for my conversation with Mark Simmer. He is the CIO at Clear Haven Capital Management.